Well, the consumer confidence report came out this week. Let's see how it affected the rates. Well, guys, looks like the consumer confidence came out actually a little bit higher than we expected, and the market is responding to it. So, bond market's responding. They don't really like it, and till they dive into it, they're probably not going to calm down, and that has pushed interest rates a little bit higher. I know everybody's been seeing in the news this week, especially me. I'm saying like, hey, rates are the lowest they've ever been. That is not true. They would have to actually get in a time machine, go back to like probably about last Thursday, and then they would be correct. So don't believe the hype. Rates have gotten just a little bit worse this week than they were last week. Last week, they were probably at their best. So let's go look at the charts and see what actually happened. So first, let's go look at the mortgage-backed securities. I'm going to drop down here, and I want you to see that. Here's what I was saying. So last week, interest rates pretty much were at the best they've really been all year. So don't believe what the media is saying out there this week. They did get a little bit worse. So as you can see down here, we just dropped from 101.58 down to 101.07. So that's just been the trend this week. Not a lot of crazy economic news come out, so we haven't seen any drastic changes. Now, the 10-year U.S. Treasury, I think we need to take a closer look at that. So let's look at that right now. So we're at 4.17. Now remember, we were down in the threes just a few weeks ago, and now we're all the way up in the fours. So you understand that bond market goes up. That's a good indicator that rates are going up. And you can see here, same thing. We look a lot better here, and we keep climbing. But we're hitting some resistance. So somebody asked me, hey, what are these lines here? So let's go look at those lines. You're going to see up here, you're going to see a 50-day moving average, which is in black, a 100-day moving average, which is purple, 200, which is blue, and that, and a 25-day, which is red. So this is just taking the average of where the bond market has been or where the mortgage-backed securities have been over that time period. So you can understand, the longer the time period, the stronger should be the resistance in something happening to resist it from breaking through that line. That's the way I look at it. So Barry Habib looks at it. So we are hitting the black line here, which is a 50-day moving average, and we've already gone up above the 200-day moving average. So this is some resistance. We'll see if we bounce back off of it. That's fine and dandy. Just understand, guys, that's what those lines mean. So those lines are talking about the daily moving average over this amount of time. 200 days, 100 days, 50 days, and 25 days. So hope that makes sense. If you have any questions, go ahead and just DM me, give me some questions, and I'll try to get back to you. So that's the 10-year U.S., the mortgage-backed securities again. You can see that same trend. So, folks, that's it for this week. Rates got just a little bit worse. And remember, don't believe the hype as far as the media talking about rates going down. They are going to go down. I think that is going to be the trend this year, but it's going to be a bumpy ride. It's not going to be a straight slide. So, if you guys have any questions, go ahead, DM me, or, make a comment down. I'll try to respond to the comments. Please subscribe to the channel or like it. That'd be fantastic. Both would be even better. And I hope you guys have a fantastic weekend.